Hello again, it's James Adair with Sierra Pacific Mortgage. Welcome back. Home Buying 101 class. Our last session, we kind of went through the four things that lenders are always looking for when they're trying to approve your loan. So that's kind of like the high level, what's happening in the mortgage. But this time I wanted to really just talk about the sequence of events. And on my website at pdxhomeloan.com, I made this really cool infographic. And it's the step-by-step guide to getting a mortgage, right? So this even zooms out even further and really glosses over a lot of the mortgage detail, the process of what's happening and also why. But here's the sequence of events you can expect if you're thinking about buying a house and you've never done it before. Or if you haven't done it before, it happens the same way pretty much every time. So you find the house. Maybe you don't even find the house, but you decide you want to buy a house. You would engage with a lender or a real estate agent and call a realtor, get a referral, find a realtor you feel comfortable with. And most realtors will say, hey, well, let's get you in contact with a lender to make sure you're able to borrow the money and able to buy a house at all, and what our parameters should be. Should we be looking for $1 million house? Should we be looking for a $150,000 house, right? The lender will really kind of set those parameters for you. So that's called pre-qualification. So we go through the conversation. I take a loan application, find out where you've worked the last 2 years, where you've lived the last 2 years, how much money you make, and we also go about trying to verify that income with pay stubs, etc. We'll look at your credit history. We'll also find out how much cash you have available for a down payment, where that's going to come from, and go about documenting that. So once we have all that in place, and that process can be pretty quick. We can usually figure that out in about an hour. Okay, so that's what to expect there. And then once we have that figured out, you go back to the lender, or you go back to the real estate agent. You might write the offer on the house, and the offer gets accepted, right? But what's happening in the mortgage process behind the scenes? After pre-qualification, it goes to initial underwriting, okay? We package that file together and send it to the underwriter, and they verify all the documents that we've provided and match it up with the lender's ultimate guidelines, which is, the guidelines are created by Fannie Mae, the Federal National Mortgage Association. They're a huge, it's oftentimes referred to as a behemoth. They're basically a bond market. So they're selling mortgage bonds by the billions every day. People are buying bonds from Fannie Mae backed by mortgages. And whatever people pay for those bonds corresponds to what the rate anybody's able to achieve on a given day. So a 30-year mortgage goes to support a 30-year mortgage-backed security that someone on the other end of that is actually taking your money every month. And the lender, the Sierra Pacific Mortgage, the whatever bank you're talking to, they're really just the conduit that connects the borrower to the bondholder. Okay, we're the originator. We pipe that into the Fannie Mae system, and every month we collect that mortgage payment. Our bank is just a pass-through, a conduit. We take that money and give it to Fannie Mae every month, and just take like the tiniest little sliver for servicing. But that's the underwriter's job, is to make sure that everything we've got is in compliance with the kind of contracts that Fannie Mae is willing to use to support those bonds. Okay, so once we get in front of an underwriter once, it's what's called conditional approval. Every now and then we'll send a file to an underwriter and it just gets totally approved without the underwriter asking for anything else. But most of the time we're sending it in before we have everything and we know it, but it's just to kind of get most of the stuff out of the way, and the underwriter will make a list of small tweaks or questions that might arise by their analysis of the documentation. And generally we don't have the appraisal in hand for the first time we go in front of an underwriter. So we will get a conditional approval, and the questions the underwriter has are called conditions. So then it comes back to the processing team, comes back to me, and we come back to the borrower. We come back to you and say, okay, the underwriter wants us to clarify this bank statement. Looks like there was this non-payroll deposit of $7,000. Where is that from? That's not a paycheck. We just want to make sure that's not like a cash advance on some other credit card that we don't know about or something like that. So those are the kinds of things that the underwriter will make us clarify for them. So, and at the same time, we've ordered the appraisal. So we're going to get the official property approval. Okay, the appraiser goes out there and verifies, takes a picture of the house. They measure the house and say, okay, and they make a little floor plan map. Say this house has 3 bedrooms and 2.5 bathrooms, and it's 2,100 square feet, and it has a 6,500 square foot lot or something like that. Okay, and they put it all in the report. They pull comparable properties and prove to the bank that what you're wanting to pay for the house is within reason for this marketplace. Other houses have gone for other similar houses have sold for similar prices. The price per square foot matches up and everything, and that this is within, you're not overpaying for the house. The third party comes in and acts as acts as really the eyes of the bank, because the lender never visits your house. They just go off of what this appraiser verifies the house to be. So it's a really important document. And then once we have that report in hand, hopefully the value is at or above what you've wanted to buy the house for. If you offered $300,000 for a house, it could appraise for $310,000. That's great. That just means you're getting a good deal. We still base the entire loan on the $300,000, the agreed upon price. And on the flip side, if it appraises for $295,000, we have to reduce our loan to the lesser of your agreed upon price or the appraised value, whichever's less, right? So if it's $295,000, then our loan is now based on $295,000, and you would definitely have a conversation with the seller, possibly try to renegotiate the price down to $295,000 in that instance, or we make the loan based on $295,000 and then you tack on another $5,000 out of pocket to still buy it for $300,000. So that's what happens if it doesn't appraise at value. In a purchase, it doesn't happen that often, but it does happen sometimes, so be aware. And then once we have that report, it goes back in front of the underwriter. They analyze the appraisal and make sure there's nothing the appraiser missed or no questions that the appraisal report might create. So the underwriter goes back and re-verifies, signs off on that hopefully, and we've created, we've put in front of all the other little bits and pieces that the underwriter has asked for. So the underwriter usually sees the file 2 times, once in the beginning, and then at the end we provide the list of everything they've asked for plus the appraisal. And generally once they sign off on that, we're done. Completed the underwriting process, we go into creating the final docs. So we have a special department. All they do is make the mortgage docs, make that final mortgage contract for you to sign at the end. It goes to the title company where you will sign those documents. Most of it, you'll sign the disclosures that you've already signed along the way. You sign them again in front of the title person who is a notary. It's your wet, live signature, notarized, and then you also sign the mortgage note and deed of trust, which are the only 2 things that you will be signing that you'll have not seen prior to the very end. And that's the actual mortgage contract that gets recorded with the county. So, so this is you signing the final loan docs, getting that title, getting that deed of trust, and then we're wiring. Once all the documents are signed, they get sent back to our company, where the funding department will verify that you signed everything. We have everything we need, and then they wire in all the money. So if you're borrowing $250,000 for a $300,000 purchase, we wire in the $250,000 at that point. Once we've verified you've signed everything. Oftentimes it's a day or 2 after you sign. So in some states, everything kind of happens at once. On the East Coast, a lot of times it happens at once, but in the West Coast, in Portland, Oregon, where I'm operating and most of my clients are, we are an escrow state, so we sign and then it goes back to the lender and we fund generally the next day, sometimes 2 days after we get those docs back, so it just depends. And then once the money is wired, that's the end. That's the closing moment. The money gets wired into the escrow account. The escrow officer takes all the money, pays all the fees, pays off the existing loan, gives whatever money's left over to the seller, and then you get the keys, and it's recorded, the new mortgage contract recorded with the county, and your 30-year mortgage journey begins on that day. So that's the sequence of events, and I hope it happens to you sometime soon. Bye-bye.